This video is about diversification with respect to investing and taking a mathematical approach to it. What will be proven? Given certain assumptions, which I will go over, I can prove mathematically that diversification is almost always good. It's not acceptable to go all in on an asset that has even a small risk of going to zero. Splitting your portfolio between even two uncorrelated assets provides a huge benefit over going all in on one asset, and adding more assets continues to provide benefit generally. And it is good to put a small portion of your portfolio into potentially lucrative but risky assets. I've seen many YouTube videos where the speaker starts off by saying that this is not financial advice, and then he proceeds to give financial advice. I assume they do that in order not to get sued in case someone loses money following their advice. So this is the standard disclaimer that I am not your financial advisor and please don't sue me. And although I prove mathematically that certain things are true, any kind of mathematical proof depends on your assumptions. And if the assumptions you make aren't right, then the conclusions you draw aren't going to be right. So the assumptions I use are very important, and I'll go over them now. Assumption 1 is that it's possible to make reasonable guesses about the potential range of profits an investment might yield, but not possible to know in detail where in this range an investment might fall. However, if you want to make the math more complicated, you could, in theory, choose a different probability distribution than I will provide and go through the same process after that I did, although that makes things more complicated. And by the way, some of these slides have a lot of text. They are mostly to remind me what to say because I would forget if I didn't have the text. You don't have to read all of it. Anyway. So what it means mathematically to assume only a range of outcomes is that the probability distribution is always a rectangle. It means I know it could be from here to here, but I don't really know where in the middle it's going to fall. So this is an example probability that has a range of 1x to 10x. So 1x means you stay the same, and 10x means you get 10 times your money. And mathematically, the area under the probability distribution should be set equal to 1. So there's a 100% probability that it will fall between 1 and 10 in this example. That means an area under that rectangle of 1. Area under here. And this is just an example problem. This doesn't correspond to any real asset, so far as I know. So calculating the potential range of Tesla as an example. In the lower bound, I would assume it's possible for Tesla to fail as a company and set the lower bound at 0x. This is a long-term time horizon, by the way. I think this kind of approach only really makes sense in the long-term time horizon because you're saying you're not very good at predicting where exactly it's going to be in detail, so short-term, you can't really make short-term predictions. And anyway, I assume it's possible for Tesla to fail because it's still a new company and it has rarely had profitable years. So it's not yet really established itself. So saying that Tesla could fail seems like a reasonable assumption. In the upper bound, if I'm generous, I'll say that Tesla could monopolize the production of cars across the whole world. Then the upper bound on the market cap of its stock, if it is priced fairly, would be the market cap of all current car companies. So I looked up on the internet and did some simple math. Tesla's current stock is about $1 trillion, and the total stock of all car companies in the world is about $2.4 trillion. So in the best case scenario, where Tesla totally monopolizes car production in the whole world, taking only the automobile aspect of the Tesla company, Tesla's upper bound would be 2.4x. So Tesla as a company in the long-term time horizon could go to 0, or it could be 2.4 times as big as it is now in the best possible case scenario. Assumption 2, scale geometrically. So I've done this to make the geometric average, I've done this to make the average of the probability distribution to be equal to the geometric average of its lower bound and upper bound. I'll show that in another slide. And that is the same thing as making it so that a minus 50% trade is equally weighted with a plus 100% trade. That's because if you lose 50% and then gain 50%, you're not back to where you were. If you lose 50%, you then have to make double to get back to where you were. So that's why I use the geometric scaling. So for example, for probability distribution from 0.5x to 5x, that would be losing 50% to gaining 400%. I'd want the average to be the square root of a half times 5. That's equal to 1.58. And not the arithmetic average, which would be 2.74. So with investing, scaling geometrically is better than scaling arithmetically. So why to do it that way? I kind of explained this already. Investment profits multiply with time instead of adding. So for example, I said if you make 1.2 one year, 0.9 the next year, and 0.1 the next year, the average yearly gain appropriately calculated is not the arithmetic gain, which is this 1 plus the other divided by 3, which gives you 6.66%. It's 1 times the other times the other times the other, and then the cube root, which is 5.6%. So this is the correct way of calculating consecutive investment gains, and not this way. And as I said, if you get a minus 50% one year and then a plus 50% after that, that doesn't bring you back to where you started. It brings you to minus 25%, because a half times 1.5 is 0.75. So minus 50% is weighted equally with 100%. And with this assumption, that means getting a minus 100% or 0x is catastrophic. Your portfolio is gone and you can never recover. So how do we scale geometrically? It is accomplished by dividing the probability distribution by x, and x here is the probable gain. So if I have a rectangle function from 1 to 10, that's what it looks like unscaled, and then scaling so that it's a geometric probability distribution makes it look like this, a 1 over x function. It looks like I made a mistake and didn't graph it all the way to 10, but you can get the idea. If I did this right, the area under the blue line should be equal to 1, and so should the area under this rectangle function. So when you scale by 1 over x, you get that the median of the probability distribution is the geometric average, square root of a and b. And by the way, a here is the beginning, the start of your range, and b is the end of your range. So in this example, it's 1 to 10. And the mean is this thing, b minus a divided by natural log of b minus natural log of a. Now the median means that half the outcomes will be less than that and half will be more. And the mean is the average. Like if you did it 100 times, what would the average gain be? And they can be different. For most of these problems, the median will be a bit lower than the mean. In this example, with a random chance to have a gain up to 10x, it has a median of 3.16 and a mean of 3.9. And because of how I scale it, the mean of a single asset with a bottom range of 0x is 0. It treats the possibility of losing everything as being infinitely bad. Other assumptions, these are minor assumptions. We treat the gain in relative terms rather than absolute terms, so like 1.5x to 3x instead of something like plus 50k to 200k dollars. And we treat an investment's effect on the entire portfolio instead of just that one investment by itself. So for example, if you had an asset that could go from 0x to 50x and you put 1% of your portfolio in that, we would treat that effect on the portfolio as being like from a minus 1% to a plus 50%. So 0.99x to 1.5x. And that's why it's good to put small allocations into lucrative and risky assets, because if it's a small portion, your losses are kept small, your potential losses are kept small, but you still get to eat some of that potential lucrative gain. And how do we treat diversification? To deal with overlapping probability distributions, we take the convolution of the distribution. And this is the definition of the convolution. You don't need to concern yourself with the details probably, just the main idea is that for overlapping probability distributions, the convolution will get you the answer you want. And there are many other uses of a convolution, but this is one of them. So I'm going to do an example convolution on two rectangle functions. And just for pretend, I'm going to say I have two assets, asset 1 and asset 2, and they're identical in every way except that they are uncorrelated, which means that what happens to one doesn't affect what happens to the other. And they both have a potential range of 0.5x to 5x return over a certain time horizon. I'm going to assume a 10-year time horizon for the rest of this presentation, but you can make your own time horizon if you want. So let's say after 10 years, there's a chance the potential gain of any one asset is minus 50% to plus 400%, or 0.5x to 5x. So on the left, it shows an undiversified portfolio of 0.5x to 5x, and then a 50-50% diversification on the right of the two assets that are identical except that they're uncorrelated. And if I've done the math right, the average for both of these should be the same. The average for this one on the left should be approximately in the middle at 2.75, and the average for this one is clearly in the middle at 2.75. So the average of this convolution doesn't change the average, in this case, the most likely outcome. It just makes the most likely outcome, it just makes the average outcome more likely and the extreme outcomes less likely. It's not very likely that both assets will fail at the same time or that they'll both be tremendously successful at the same time. But it could happen that one of them fails and the other succeeds, and then you get the median, or that they both do average, or that one of them succeeds and the other fails. So there's lots of different ways of getting the average, but only one way of getting the extremes, and that's why it looks like this. The average is more likely and the extremes are less likely. When you add the geometric scaling assumption, these are the graphs you get. This is the undiversified probability distribution on the left. Looks like 1 over x. And this is the diversified portfolio allocation on the right. Now I did this in Excel. It's a piecewise function, so that's why there's two graphs. But you look at the graphs at the bottom. So it starts up here on the brown one, the darker brown one, and then in the middle where they meet, it goes down on the other lighter brown one. So the effect of diversification, in this case, even diversifying two assets that have the same likely outcome, is it makes the extreme cases less likely, and that's good for geometric scaling because the possibility of losing money is very, very bad for geometric scaling. Losing everything is infinitely bad with geometric scaling. So there's a huge area when you're undiversified between 1 and 1/2. There's a lot of probability to lose money. But when you diversify, this area is much smaller. You can probably see where you will likely lose money. I hope that makes sense. Diversification makes the average outcome more likely, and if you scale geometrically, losses really, really suck. So making the average outcome more likely makes the bad outcomes less likely, and that is good if you're scaling geometrically. So actually, just to make it clear, well anyway, I'm not going to say anything else about that. I just assume rectangle functions and then scale geometrically to make it so that to scale my losses and gains in a way that I feel is appropriate. So I'm going to use a real example of gold and Bitcoin. Actually, I meant it to be gold and Bitcoin, but I got my numbers mixed up and put the numbers for silver in place of gold. So really it's a comparison between silver and Bitcoin. I thought gold and Bitcoin would have been more appropriate, but I already used the silver numbers, so I'm not going to do it again. So anyway, it's a comparison between silver and Bitcoin. This is a chart from TradingView of silver's historical price divided by the M2 money supply. And so it's basically an inflation-adjusted price for silver. But it only goes back, I believe, to 1981, because that's when they started recording M2 money supply. So anyway, I basically took the lower bound and the upper bound and assumed that in 10 years, the price of silver will randomly fall somewhere between its historical lower bound and its historical upper bound when adjusted for inflation. You might not like that assumption, but that's the assumption I used here, and I'll do the example with that. And so I get that silver could fall in the range of 2/3 x to 10x. Now I can't do that kind of assumption for Bitcoin because Bitcoin makes a new all-time high all the time. So I found this logarithmic regression band, or they call it a power law extrapolation or trend line on the website I found it on. And I basically went for 10 years from now and saw that the upper bound is about 50x from current prices and the lower bound is about 6.6x. But Bitcoin's kind of new, so let's say for the sake of argument that Bitcoin could go to 0. So I'm going to set Bitcoin as a 0x to 50x. Although I think the longer Bitcoin is around, the more it proves itself and the less likely the 0x is. But just for the sake of argument, I'm going to say that Bitcoin has a chance of failing, in which case it's a 0x to 50x asset, which means it's a risky but lucrative asset. But if it doesn't fail, which I think is kind of unlikely at this point, but I'm not going to say it's impossible, then I would assume it would probably fall in this range. Like, I don't have any reason to suspect that it wouldn't continue to do what it's been doing for the last 10 years. Anyway, but I'm not going to deal with that in this example problem. So the overview of the silver Bitcoin example problem is I'm assuming I put some percentage of my portfolio in silver and some portion of my portfolio in Bitcoin and leave it alone for 10 years. I assume that silver will randomly fall somewhere in its inflation-adjusted historic range 10 years from now, yielding 2/3 x to 10x. So I like silver because it's undervalued at the moment, although in the future it might not be undervalued. And this produces an average gain of 3.4x. I assume that Bitcoin will continue to follow historical trends, and for the sake of argument, I'll say there's some chance that Bitcoin will fail. That yields 0x to 50x 10 years from now. And by the way, this is consistent with trends. What I've seen, that Bitcoin will probably become a mature asset in 10 years, and when it's mature, it will be eating the bond market. So actually, this is very consistent with, this price prediction is very consistent with my overall view of Bitcoin. And there is no average for Bitcoin in this example problem because geometric scaling treats the chance of getting 0x as infinitely bad. So you'd never go all in on Bitcoin if you think there's some chance it could fail. And this is the result of a 50-50% silver Bitcoin diversification portfolio. And again, I did a convolution and used Excel to help me. It was really a pain in the butt to do that. It took a lot of effort. But basically it starts on this blue line. When it meets the orange line, then that's the real one. And then when it meets the gray one, that's the real one. So take the lowest graph at any possible moment. So, and at the origin, it's not exactly right. I didn't graph it on Excel all the way to 0. So I believe the range is actually from 0.2 all the way, no, it's a bit more than that. It's from 1/3 to 30.5 apparently. So anyway, the average result from only silver is only 3.4x, and the average result from Bitcoin is 0x because the possibility of losing everything is infinitely bad with geometric scaling. And when you average them, you get 9.9x as an average, not the upper bound. The median is complicated to calculate, and I didn't do it. I would guess just from eyeballing it, maybe it's at about 8. That's just eyeballing though. And you should be able to use this kind of math to predict an ideal silver Bitcoin portfolio distribution. According to my assumptions, a portfolio consisting entirely of silver and Bitcoin ought to have a 70% Bitcoin allocation for maximum gains, yielding an average gain of 10.6x. However, this covers a huge range of possible outcomes from 0.2x to 38x, so a conservative investor may be interested in a lower but more certain average gain. Because even with all of my assumptions just say that 10.6x is an average, but it's not saying it's actually unlikely that you could lose money. That's not what it's saying at all. Okay. Now, I came up with an easier way of calculating average gains for a diversified portfolio. I'm not sure this is technically correct, but I think it should get you close to the right answer. I haven't proven mathematically that this works. So the full convolution and integrals on the example I did was very tedious and time consuming. I'm not going to do that with every asset I think about. So I thought maybe for assets 1 and 2, I can calculate the mean of 1 first, and then use that to calculate the total mean. So the mean of one asset is B1 minus A1, you can see it. And then I combine M1 with the range of the second asset. So B2 would be the upper range of the second asset, and A2 would be the lower range of the second asset, and P is the proportion in your portfolio of asset 2. So you use this equation, and I got almost exactly the same equation with this. I got almost the exact same results with this as I did from actually doing the full calculation in Excel. So I believe the difference is probably just rounding error. So from a test, I believe that this likely will get you the same result, but I can't prove it. And this equation, these two equations are much easier to do than what I did in Excel. That was very difficult. Now some addendums, which I have quite a few of. Diversification only works for uncorrelated assets. 50% in Dogecoin and 50% in Shiba Inu is not diversification because the entire crypto asset class is correlated. Likewise, choosing assets that are anti-correlated, that move in opposite directions, like I think generally it's understood bonds and stocks move in opposite directions, make it hard to either gain or lose money. Although they're not entirely correlated, but they're kind of correlated, anti-correlated. Anyway, if you had two assets that were exactly anti-correlated, then diversification would make it impossible to gain or lose money. How did that happen? Did it copy the slides? Okay, anyway, diversification only really makes sense if the asset you're adding to your portfolio has either a higher or lower bound, which means it's less risky, or a higher upper bound, which means it's more lucrative than the rest of your portfolio. So in other words, if you add a not risky asset to your portfolio, it lowers your potential losses. And if you add a risky but potentially lucrative asset to your portfolio, it increases your potential gains. So those two could work together to limit losses and get some gains at the same time if you have a low risk and high possible reward asset together in your portfolio. But if an asset is both more risky and less lucrative than the rest of your portfolio, then I don't think there would be any gain from adding it. And more on 0x with geometric scaling. So 0x on your portfolio is treated as infinitely bad with geometric scaling, because it's impossible to recover from. It means all your money is gone and you need money to make money with investing. So if you ever lose all your money, you're just screwed. If you lived for 1,000 years investing with 99% accuracy, but without diversification, you would eventually be wiped out because of the 1% chance of a 0x, unless you got a bailout. So I believe anyone who uses reckless trading strategies, who appears to be successful, just hasn't lived long enough to suffer the consequences of his reckless trading. And on using leverage with this investing model, leverage and debt in general is not compatible with the investing model I've proposed. My model already treats 0x as infinitely bad, so the possibility of losing more than everything doesn't make any sense. Leverage and debt in general is not compatible with diversification. If diversification means that the different parts of your portfolio do not affect each other, then having the possibility to lose more than 100% on any particular trade means that you have no diversification. So any allocation which can lose more than 100% will damage your entire portfolio if it goes bad. And that to me means you're not diversified. A system with leverage is also not correlated with physical reality. If you're using leverage in a system, it means you're trying to trade more of something than that thing actually exists. It will always run into some kind of problem. Now I'm going to look into some other assets. You saw how I took the historical price of silver and divided it by the money supply to get a range that I think silver could fall in the future. I'm going to do the same thing to a bunch of other assets. Bitcoin is the only asset I didn't treat that way because since it's only ever gone up in its history over long periods of time, that doesn't really make sense. And note that looking at historical charts divided by the money supply and assuming a mean reversion only works if the asset is actually a mean reverting asset. As can be seen in some of the charts, mean reversion seems not to be as good of an assumption for some assets as for others. So anyway, stocks, it looks like here, starting in about 1990, stocks have been approximately a mean reverting asset. Stocks seem to have permanently been higher for the last couple decades than they were in the 1980s. But since then, they seem to be mean reverting. But if you include the 1980s time, then you get that stocks are, at the present time, are a 0.28 to 0.16 asset. That means you're probably going to lose money because they are historically overvalued. Adjusted for monetary inflation, actually stocks peaked back in 2001. And right now they're at about the same level they were in 2008 and the COVID crash in 2020. So I'm not very favorable on stocks at the moment, just based on historical trends. I think it's unlikely they'll beat inflation in the long run. Housing is kind of a weird thing. It looks like it was mean reverting for the period from 1980 to 2008, and then it went down and didn't get back up and was mean reverting again, I don't know, since like 2011 about. But if you assume it'll mean revert, then it's a very good trade right now, 0.95x to 2.1x. That means it's almost guaranteed gain. Not as lucrative as some other assets, but almost impossible to lose if you assume housing is a mean reverting asset. Although it's kind of a weird thing because if you compare housing to wages, houses are actually more expensive now than they've ever been. But if you compare housing to the money supply, then they're cheaper than they've ever been. So it's kind of a weird situation. I think probably the money that the government threw at the housing market makes houses more expensive for buyers, but doesn't increase the profits of house builders by very much because of the way they do it. And so that probably produces a permanent shortage of housing, which gives you the weird situation where no one can afford a house and yet the price of housing continues to go up. And actually, if you don't include Bitcoin, housing has been the best performing asset for the last several decades, so that's something to think about too. Best performing asset class. Oh, and by the way, about stocks, this is the S&P 500 divided by the M2 money supply. But individual stocks, there are always individual stocks that perform worse than the average and individual stocks that perform better than the average. So even if you agree with me that the average stock performance is probably not going to be very good in the next 10 years, you might be able to find individual stocks that are worth buying. It would take research and diligence and intelligence to figure that out, though. Oil looks like it is a mean reverting asset. I ignored this weird part of the chart where oil went negative for a bit, and but from 1981 it looks like oil was a pretty mean reverting asset, and from the mean it never increased or dropped by more than about 50%, I think. Or maybe I'm thinking of a different asset. Anyway, oil is pretty much mean reverting, and at the moment it seems to be a little bit undervalued. If you bought it back in the COVID crash, that would have been a really good thing, or buying an oil company maybe. Looks like a lot of the opportunity for profit is gone now, though. Lumber, I included this, but if you think it's a mean reverting asset, lumber is probably a good thing to buy. But the long-term trend seems to be down. Maybe people are finding more efficient ways of getting lumber. So if you assume it's a mean reverting asset, then it's a good buy. But it seems questionable to me whether lumber is actually mean reverting. And if you bought it during the COVID crash, that would have again given you a huge profit if you sold it at the right time. Bonds, I divided one by the bond yield because the yield is inversely proportionate to the price of the bond, and then divided that by the money supply. And if you do that, you get that historically bond prices do appear to be mean reverting. They never go very much above or very much below the mean, with the exception of the past couple of years where you can see we've had both a higher high, we've had both an all-time high and an all-time low within the last year or so. So if you assume that bonds are a mean reverting asset, then because they're at an all-time low right now, they are a very strong buy, 1x to 3.6x, with a mean of 2.9. So if you trust the financial system, it's a very good buy. If you think there's a possibility of hyperinflation like I do, and account for the current real return of minus 5%, then bonds are a 0x to 0.6x asset over a 10-year period. So they are a return-free risk. So if you trust the current financial system, then bonds are a great buy right now. If you don't trust the current financial system, then they are absolute trash. Something else to note is that we keep getting lower lows. It looks like starting from about here, there is a low back here, then a lower low here, a new all-time low, then a new all-time low here and here, and a new all-time low here, and a new all-time low here. So the lows of bonds are getting lower and lower with time, although you might also be able to say the same thing for the highs. So anyway, bonds are getting more volatile than they used to be. Actually, I do seem to recall Mike Maloney saying several years ago that he was predicting roller coaster inflation and deflation ending in hyperinflation, and this seems to be consistent with what he said. Anyway, summary of assets over a 10-year period. And I chose 10 years because it's a round number, and because I assume 10 years is long enough for basically anything to happen. So bonds, if you treat them generously, they're a strong buy. Critically, as like the worst asset possible, depending on whether you trust the financial system or don't trust it. Stocks, based on historical averages, you're going to lose your money over the next 10 years. Housing, based on historical averages, are a good buy. Not particularly lucrative, but with very little risk if you assume that they are mean reverting. Oil is probably a pretty good buy, but it's risky. Lumber, it would be a good buy if you assume it's mean reverting, but that seems questionable to me. Silver, if you assume it's mean reverting, is a very strong buy. And Bitcoin, if you think that there's even a possibility, even if you think Bitcoin will probably fail, if you think there is even a possibility it could keep doing what it's been doing for the next 10 years, then it is a pretty good thing to include in your portfolio. Not all of it, but not your entire portfolio, but at least part of it. Or if you assume failure of Bitcoin is impossible, then Bitcoin is a 6.6 to 50x asset over 10 years based on current prices, which gives you an average gain of 21x. So if you think it's totally impossible that Bitcoin could fail, it's actually not a bad idea to go all in Bitcoin. Nothing else even comes close to being that good. I think maybe there is some chance of failure, so I personally have a lot of silver and a lot of Bitcoin. Actually, approximately in the ideal ratio that I told you about before. I actually did that on accident. I had that ratio by accident before I did this calculation, but my current portfolio is pretty close to that. So anyway, I'm personally biased towards thinking that the debt-backed dollar system is unsustainable, and I am therefore unfavorable towards bonds and favorable towards competitors to the currency, such as precious metals and Bitcoin. I might also diversify a bit into other assets such as housing or commodities, but it seems to me that silver and Bitcoin are the two big players for me, or basically precious metals in general and crypto in general. And obviously gold is the biggest player in precious metals, although silver might outperform it, and Bitcoin is the biggest player in crypto, and if you're lucky, some other coin might outperform it, like Ethereum or maybe some smaller altcoin. I don't really know. But you can make your own portfolio based on your own assumptions. In summary, with these two general assumptions, with these two general assumptions, one that you can estimate reasonable upper ranges and lower ranges for asset prices, but not accurately predict anything in between, and if you assume geometric scaling, then you can prove mathematically, as I just showed you, that going all in on an asset which can go to zero is unacceptable. Diversifying between even two uncorrelated assets provides very great benefit, and small allocations into lucrative or risky assets is usually beneficial. And a good general portfolio allocation would be made largely of safer assets. That means they have a high lower bound to their performance. In other words, very little you could lose, with a variety of small allocations to lucrative assets or high upper bound assets. I think this is a generally good plan for your portfolio, if you want to limit your losses while also having access to big gains. Okay, that is the summary.